You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIWTweets.
Hello, welcome to The Investor Way with me, Sam Ball. I'm joined today by Adam Mead. Adam Mead is the CEO and Chief Investment Officer of Mead Capital Management, LLC, a value-focused New Hampshire-based registered investment advisor he founded in 2014. He's also the founder of WatchListInvesting.com, a monthly research letter focused on quality companies. Adam spent over a decade in banking and commercial credit and has been investing in public security markets since 2004. He owned two small businesses which were non-financial during college and grew up in a family of small business owners. In addition to managing assets for his clients at Mead Capital, Adam is on the board of three local non-profit organisations. Adam has been covered by Business Insider and the Wall Street Journal. Thanks for coming on the show today, Adam. Could you just start by just telling us how you actually became interested in investing and just talk us through your investing career to date?
Sure. So I'll expand that to business and investing because I've come from a family of small business owners. I've always been around business. My grandfather had a tree service company. My father had a trucking business and a real estate company. And so business has always been a part of my life. And then investing kind of just came into the picture, maybe when I was in my mid-teens. My grandmother actually gifted me and my siblings 25 shares of what became AT&T. So it was a pretty small gift. So that kind of brought together the two, business is investing is business, but that my sort of first taste of the stock market. And then when I turned 18, the day after I turned 18, I opened a brokerage account and it was kind of off to the races. So, and then it just went from there. And as you know, Sam, anybody who's in investing, certainly, but even in the business world, eventually you're going to come across Warren Buffett. So he came into my orbit and it's just been down the rabbit hole ever since.
Okay, so how did you make that transition then from a private investor to a professional investor like you are now?
Really just a process of continual learning and I guess, what makes a professional investor versus a non-professional, is it the license or what have you? You could argue that it is, but the line is blurred, I guess you could say. But I just, I continued to go down the path. I really liked it. And eventually I had some friends and family asked me to manage their money. And I said, well, if I'm going to do this, I want to do it the right way. And so I actually went out, got registered as an investment advisor, which is the requirement here in the United States, and formed an LLC and did it all officially and on board and all of that. So that's how Mead Capital came about, was request by friends and family to have them manage their money as alongside my own.
So how did Watchlist Investing come about then?
So that's, I wish I had started it sooner. This whole growth of online newsletters, a friend had said, geez, you should start a newsletter. I said, well, do I have the time for this? And, most newsletters are kind of, an idea a week or an idea a month. And I said, geez, I can't come up with this large volume of ideas. So it's essentially an extension of what I'm doing already. I'm taking the research that I'm doing for clients and just kind of putting it out there to the world. And watchlist investing, it just, the name came about because the way I approach investing is to build a watch list of good companies, regardless of whether they're attractively priced or not, get to know them. And then if and when something happens that creates a dislocation between the price and the value, as I've determined it, then I'll buy it. So I said, well, geez, I can research, I can put out an idea every single month or multiple ideas every single month and find and uncover these good companies and build this watch list sort of publicly, if you will. And subscribers have access to a Google sheet that has the companies that are covered in each issue. So I view it very much as complementary to my primary investment business. Of course, I have a fiduciary responsibility to clients. So if there's any unique idea, clients get that first. And the newsletter is just that, a newsletter. It's not any official advice, anything like that, but it is very complimentary.
So obviously you've written the book. Do you want to talk about that and how that came about as well then?
Yeah. So I just once I hit Buffett, I just went deep, devoured everything I could find on him. You know, my bookshelf here is just packed with Buffett and Berkshire and Munger. And Chris Bloomstrand, who wrote the foreword to my book, he found through the Library of Congress, there's over 200 titles on Buffett, Berkshire, or Munger. And so, you know, why write another book? Well, I guess the short answer is I wrote the book I never found, Sam, which is Berkshire A to Z, you know, kind of geek out on the financials, let Buffett speak, don't try to outdo him, but really just pull all of that great information that's in the annual reports and the 10Ks forward to the reader. Because I would find myself, for example, a couple of years ago, Buffett stopped doing this in his letters, but he would say, okay, the MSR businesses had a 17.2% return on tangible capital. I said, well, how did he get this number? And so I'd go into the 10K and I'd try to calculate it. And I said, that's the book that I wanted. And I wanted it, year by year. I'm a very logical person. And so it just year by year, decade by decade. And to my great delight, there has been a number of people like me out there that have really enjoyed it. And for others, if it serves as a reference book, that's okay too. Because it is structured the way it is. And then I have a companion website for the book as well, theoraclesclassroom.com or brkbook.com with all kinds of goodies on that site.
So for anyone who's not familiar with the book, it's basically a history of Berkshire Hathaway, and it's from before Buffett got involved. It's up to the present day, isn't it?
Yeah. So my original idea, Sam, was to start, I said, how can I go through this? And it took me 5 years to write the book. But so 2015, 16, I was kind of kicking around these ideas. And I said, I want to look at Berkshire again, year by year, but kind of pause at certain points and look at the capital allocation decisions that were made over a decade. And so I said, well, I'm going to start, the book is surround, it begins or is sort of bookended, if you will, or the origin is 1965 when Buffett took control. So I said my original idea was to go back to 1955, work every year forward, and then pause it every 10 years to examine the decade. And so I wrote the first 2 chapters. I sent it to Warren, and to my surprise, he wrote back and he said, glad you're doing this. Wouldn't it be interesting if you went back to the World War II era and took a look at the companies, the predecessor companies, and how they enjoyed this extreme but very temporary blip in profitability because of World War II? And I said, well, of course, if Warren Buffett's suggesting this, I'm going to do it. But that led me to go all the way back. And so the first chapter starts, literally the origins of the textile industry in the United States in 1789 with Samuel Slater, and then walks forward and follows and the industry as well as these many predecessor companies until they eventually sort of congeal into first Berkshire Hathaway or Berkshire Fine Spinning Associates, and then on this parallel track was Hathaway Manufacturing, and then in 1955 they merged to become Berkshire Hathaway, and then that history continues year by year from there.
So do you want to briefly go through the history then, decade by decade, with just the key stuff that's happened, just to whet everyone's appetite?
Sure. Yeah, and really, when you look at Berkshire Hathaway today, and even if you looked at it, 20 years ago, its early history is you're really looking at 2 different companies, right? I mean, you had this old failing textile company, and then you have the conglomerate that's respected and admired today. We very well could be talking about, blue chip stamps today, which is one company that Buffett invested in. It's just sort of an accident of history that Warren Buffett chose Berkshire Hathaway as his investment vehicle. But I hope the early history of Berkshire is instructive to students of business or investing, because it really is, there's a simple business there, right? And so you have a textile manufacturer. It has working capital requirements. It has fixed asset requirements. It has liabilities. There's depreciation. All of these things you can learn, really the basics of business, from studying this early textile business. And then, of course, as the years go on, the competitive forces, both within the United States as well as from overseas, that ultimately kind of sink the economics of the business. So you can see that as you go through the 1930s, the 1940s, into the 1950s, when Berkshire Hathaway really was just a textile business. And like I said, I organized the chapters in decades, and the decades are, for example, the next one, the first major one in the book is 55 to 64, because again, it's centered on the year that Buffett came to Berkshire. So 55 to 64 was really interesting, Sam, is that the management of Berkshire Hathaway at the time actually shrunk the business in half during this decade. And they returned capital to shareholders in the form of dividends and share repurchases. And that was ultimately what led Warren Buffett to get interested in Berkshire Hathaway, because he saw this business just repurchasing its own shares. When it did this, the stock price would go up, and it was really one of these classic cigar butts. So Berkshire Hathaway last appeared on the Fortune 500 in 1959. It was 499th. And then it fell down, and then eventually came back on. So that's really that decade, the 55 to 64 decade, was sort of this struggling textile manufacturer that was returning capital to shareholders. 1965, Warren Buffett takes control in May, and again, he uses Berkshire Hathaway as his base to create this empire. It was sort of accidental. He said in the past that if he were thinking more rationally, he would have just formed another investment vehicle to acquire first. The biggest acquisition, the most important acquisition in Berkshire's history probably, was National Indemnity in 1967 for $8.6 million. 1969, they acquire the Illinois National Bank and Trust, which actually, interestingly, was the largest acquisition in Berkshire's history as a percentage of its equity capital at the time. It was 44% of Berkshire's equity, even bigger than National Indemnity. This decade, we see Blue Chip Stamps, which Berkshire owned a portion of, but Blue Chip acquired Seas. Eventually, it all rolled up into Berkshire. They really build on to the insurance group at this point. So National Indemnity was the foundation. Then they actually formed a whole bunch of these home, state, and workers' comp businesses as well. 1973, the Washington Post for a little over $10.5 million. I think they bought about 10% of the company. So that decade was really the beginning of this sort of recycling of the textile capital into better businesses. And then we move forward to the next decade, 75 to 84. Interestingly, even though Buffett knows that the textile business is difficult, he goes out and buys a mill called Wambeck Mills in Manchester, New Hampshire. He buys it well below book value. It was such a distressed price, in fact, that when they booked it on Berkshire's financial statements, there's no property, plant, and equipment put on the books. It was a mistake. Eventually, the mill was closed. That was a small acquisition, but notable because it was an additional acquisition in 1975, even when Buffett knew it was difficult. Buffalo News was in this decade. Berkshire actually technically merged with Diversified Retailing, which was another business that was owned by Buffett, Munger, and Sandy Gottesman. One divestiture. So I mentioned the Illinois National Bank and Trust, which was acquired in 1969. United States banking regulations forced Berkshire to divest of this bank before 1980. So they did it. They spun it off, and it was an example of it was a rare divestiture. But Buffett actually set the terms of this, and he used the term "I cut, you choose." He took the residual, and as it turned out, the split was appropriate enough that if you had chosen either, you would have done equally as well, whether you chose Berkshire or the bank to put your future in. The Blue Chip Stamps, they merged in 1983. Nebraska Furniture Mart was part of this decade. And then Geico, General Foods, Exxon. These are some of the bigger investments. Geico at that point was not a wholly owned subsidiary, but it was the first time that Berkshire invested in Geico when it was a security at that point. So then we move on to the 85 to 94 decade. The big thing here, Berkshire cuts loose and actually shuts down the textile operations. And now it's on its own. So all that capital inside Berkshire, with the exception of diversified retailing and the blue chip stamps, original capital, came from this recycled textile operation, essentially. Then we see this is kind of a fun decade because Berkshire is big enough to do some of these sort of interesting, newsworthy things, but it's small enough that it's nimble and has a huge runway ahead of it. And so I'm thinking of Capital Cities ABC, where Berkshire invests, I think 18% of this combined company that helps Capital Cities buy ABC. Scott Fetzer, 1986. This is one of my favorite acquisitions. This business had about 700 million in revenues. It nearly doubles Berkshire's revenue base, about the same in terms of its assets. And it's a company that's kind of largely forgotten about today, but it's interesting because it was a mini conglomerate of about 20 businesses. The largest two were Kirby and World Book. And as a whole, these businesses didn't have a huge growth potential, but they earned, in some cases, over 100% return on the capital employed in the business. And what Berkshire did was take that capital and recycle it into things like Capital Cities, like we just talked about, or Coca-Cola, or Salomon Brothers. But Scott Fetzer didn't grow very much. So actually, just a little sort of look ahead, Scott Fetzer literally fades to a footnote in Berkshire's financial statements in 2003 because it becomes so small relative to the other businesses in Berkshire. But that doesn't mean it was a poor business or a mistake. In fact, the opposite. It was just such a good business that didn't grow, but Berkshire grew up around it, so to speak. Mentioned Coca-Cola is another big one in this decade. Berkshire buys into the shoe companies, of course, making the big mistake in buying Dexter Shoe in 93 by issuing a bunch of shares. And then through Wesco, which was another controlled operation, but not 100%, they exited the savings and loan business through Mutual Savings, which is a fascinating little story and classic Charlie Munger for anybody who knows Charlie. Doesn't mince words, and I'd recommend reading in the entirety the public statement that they made when they exited Mutual Savings. It was just a debacle. And then in the insurance business, so that business is growing again organically as well as forming new businesses. Berkshire enters the supercat business in 1990, which is insuring, hurricanes and other earthquakes and fires and big risks and things like that. 95 to 2004, so jumping ahead to the next decade, you have a whole ton of things that happen in this decade. I won't go through all of them, but the big ones, they buy the remaining half of Geico for $2.3 billion, and the first half cost them $47 million, which is just an awesome statistic, just to show how that value creation grows over time, and Berkshire's willingness to recognize the value and purchase it. They issue Class B shares during this decade for the first time. And then they have all these other big acquisitions. Early 2000s, they buy companies like Justin Industries, which has a subsidiary, Acme Brick, Shaw Carpet, Johns Manville, which makes insulation. These sort of boring businesses, which, if you remember at the time, this was all around the dot-com boom of the early 2000s. So everybody's excited about tech, right? The parallels to today. Everybody's excited about tech. Berkshire buys these boring businesses. McLean, they buy this. It's a distributor, a trucking distributor that they purchased from Walmart in 2003. Clayton Homes, another sort of basic but boring business. The big two big acquisitions in this decade, Sam. One was General Reinsurance, which was this behemoth United States domiciled reinsurance business. They have operations worldwide, but it was domiciled in the United States. General Re was sort of the second leg that it really, really brought Berkshire into the reinsurance space in a big way. This is a very interesting, I'll give Chris Bloomstrand credit for, I think he calls it the great pivot. The General Re acquisition, if you look at Berkshire's split between stocks and bonds, very heavy in stocks. So this is 1998. Stocks are running up. So very heavy into stocks compared to bonds. Berkshire has all these positions that they've held for a long time, like American Express, Coca-Cola, and so forth. By buying General Re, and they bought it with shares for $22 billion, Berkshire's stock itself was at the time overvalued. So they purchased an overvalued business with overvalued stock, which if you sort of do the math, they got it on a 1-to-1 basis for their float, insurance float. But what this essentially does is allows them to reduce the level of stocks to bonds in a tax-free manner. It was really just a brilliant acquisition. Ultimately, Gen Re hits a tough spot. 2001 happens with the Trade Center terrorist attack. They were exposed. There was a couple of years of losses, but Gen Re pulls through. Then I just quickly mentioned Berkshire Hathaway Energy, which was purchased in 1999, a majority interest. And that becomes another leg of Berkshire Hathaway, sort of its future in terms of more capital intensive business, but excellent long-term prospects with known returns. Continue to the 04 to 14 decade. Again, a whole bunch of businesses. I won't touch on every single one, but Iscar was one of Berkshire's first foreign acquisitions. It was based in Israel. They make cutting tools. Marmon, which was it would be one of the largest Fortune 500 companies, but it owned, Marmon itself had about 120 companies when Berkshire bought it, just to show you the size of it. And then, of course, this is the decade of the great financial crisis. Berkshire invests $14.5 billion in a matter of 2 weeks into General Electric, Wrigley, and Goldman Sachs, in addition to some other things that they did. They bought Lubrizol, another energy business, a whole host of different things that they did in this decade. And of course, Burlington Northern Santa Fe, the railroad. The next 5 years that I cover in the book, 15 to 19, again, a whole host of other acquisitions, the biggest of which was Precision Castparts for about $33 billion, which we know today, in hindsight, Berkshire overpaid for that business. But the business itself was a very good business, is a very good business. Couple of small insurance acquisitions, some other non-insurance acquisitions. And interestingly, in this decade, this half decade, I should say, so I found the largest acquisitions by Berkshire in its history. And it's interesting, Sam, to see as the years went on, Berkshire just bought larger and larger and larger companies. So it maintained that concentration. But because Berkshire didn't pay a dividend, and before the last couple of years, it wasn't repurchasing shares, the amount of capital generated by Berkshire Hathaway just in the last 5 years here, 15 to 19, was about 43%, a little over 40% of all of the capital ever generated in Berkshire's history. So this just illustrates this compounding effect that retained earnings at a healthy rate of return does to a company. So that was quite the mouthful, quite a history. A lot more detail and nuance in the book, of course, and I'm sure I've forgotten more than a few things here.
Well, I'm sure you've forgotten more than the rest of us ever knew. So there's a few points that I did want to cover in I guess a bit more detail, just because of typically they're important. So I think you covered the Gen Re one where they added all the bonds. I was wondering if you could just talk about the original acquisition and how Buffett did come to own it, because like you say, it wasn't a very efficient thing to do. And it was much more, I think, of an emotional decision than people who haven't studied the company actually realize.
Yeah, it's a great question. So Warren Buffett, and I don't talk in the book about Buffett's early days or anything like that. I really focus on Berkshire, which of course becomes Warren Buffett. But Warren Buffett had an investment partnership called Buffett Partners Limited, which he ran from the mid-1950s to 1969. So Berkshire Hathaway, as I mentioned when I was talking about it, the early days was this cigar butt, was this company that he could buy with this surplus of working capital, even after you subtract the debt, compared to the share price. And again, they were selling off plants and buying back shares. And he saw this just as a quick buck. he accumulated enough shares that he came on the radar of the company. And so Buffett went to go meet with Seabury Stanton, who was the president of the company at the time. And Stanton made an offer and said, hey, we're thinking about doing this tender offer. And, we're going to offer, I think, $11.50 per share. So $11.50. Buffett says, fine, I'll sell you my shares at that price. The official offer comes and it's 12.5 cents less, because they were quoted in eighths at the time. This sets Buffett off and says, you know what? He reneged on his deal. I'm just going to buy as much shares. I'm going to buy control of this business. So it was kind of the dog catches the moving car, right? So he takes control in May of 1965, and the rest is history, right? But he was the dog that caught the car and was, okay, now that we're in this business, what do we do about it? And of course, you have a stock picker. He's not just interested in making Berkshire Hathaway the best textile business he can. He sees capital as a fungible commodity, and of course, the rest is history there.
So one of the other ones was you sort of touched on it, but the importance of National Indemnity, just in terms of not only is the first acquisition, but it gave them the first lot of flow, and the importance of that to the ability to compound.
Yeah, so a couple things with National Indemnity. Jack Ringwald, who founded National Indemnity, he was a handicapper. So he said there was no such thing as a bad risk, just an improperly priced risk. So he would literally insure lion tamers and poor drivers, and just it was not kind of like the difference between say home insurance or your car insurance and a credit card, right? Credit card companies, unsecured, you're going to pay a higher interest rate, but that compensates for the risk. So that's what Ringwald did. He said, we'll insure anybody. You're just going to pay for it. And so that really showed Buffett, one, that an insurance company could be run well, but two, this sort of mode of thinking of not just a Geico, for example, which is sort of the statistical based business where you're just finding an average driver, insuring that driver above average. It's really pricing any risk. But what he came to understand, he didn't fully understand National Indemnity when he bought it. He didn't fully understand the value of float. This was only after that he really came to realize it. National Indemnity had almost 20 million of float, and they bought this business for 8.6 million. They got a steal. So float, just to remind or tell your listeners, float is money that an insurance company holds that does not belong to them. So it's the auto premium that you have to prepay in advance, comes out of your checkbook, but it goes on the balance of the companies. But they can earn interest from any kind of, if it's invested in bonds, or if they invested in stocks, they get to use the money and make money with that. You don't get the credit for it. Same with losses. That's a little bit less intuitive. If you get into a car accident and the insurance company has not yet paid you what it owes you, or fixes your car, that's money that it holds that hasn't been paid out. And so as insurers write business and incur losses and do more business, there's this pool of capital that sits on the books as a liability, but has the ability to earn something for the insurer. And so that's really today Berkshire has 140 billion of this float, which is money that's technically owed to someone else, but Berkshire can invest for its own benefit.
The next one was See's Candy. It's obviously a small acquisition, but it's probably the most famous one, in that it's the one that's known as the one where almost it changed their mindset towards valuation and investing. So I was wondering if you'd just talk about that one.
So See's Candy was originally purchased by Blue Chip Stamps. Blue Chip became part of Berkshire. But it was just all kind of this tangled mess. Effectively, Berkshire bought See's Candy. They paid about 3 times book value for this business, but it was a business that was earning well into the double-digit returns on capital. And so it was really Charlie Munger that convinced Buffett, because Buffett had this Benjamin Graham mindset of buying the Berkshire Hathaways, buying the businesses that were just cheap, And Charlie could see that if you buy a good business, it has pricing power, it has staying power, you don't have to make another decision. And so Seas was sort of the first of the quality companies that Berkshire Hathaway purchased. And as Buffett has said, Seas ultimately led them to recognize the value in Coca-Cola. Seas did not have the reinvestment opportunities. So Seas was kind of like the Scott Fetzer that I mentioned, in which it was a great business. They sent all the cash to Omaha, but it didn't grow very well. And just like Scott Fetzer, Seas sort of fades to the other category over time, but it's still there, earning a great return. Coca-Cola, by contrast, had this reinvestment opportunity, and of course, we know Berkshire has owned that since 1988, and I think is probably valued on the books maybe 15 to 18 to 20 times their original purchase price, and has spit off hundreds and hundreds of millions of dollars a year in dividends to Berkshire.
And the last one was just whether or not it came through in the numbers, the importance of Ajit.
Yeah, Ajit Jain. So Buffett, I pretty much think every single letter probably since the mid 1980s has mentioned Ajit Jain and his value to Berkshire. And Ajit Jain was originally from India. Again, the famous story, he walks into Berkshire's offices in 1985. This guy, Mike Goldberg, at the time was running the insurance unit, finds Ajit Jain. He knows nothing about insurance, learns it very quickly, and Ajit becomes, he's now the vice chairman for insurance operations. Ajit really is the brains behind Berkshire's insurance operations in a very big way. He's an excellent handicapper. He understands risks and pricing and the combination of risks and just everything that's related to it. Ajit, and you can see it's interesting, from 82 to 92, roughly this 10-year period, Berkshire loses money in insurance underwriting every single year, to the tune of a total of about $500 million. Now, they make money up on the investment side of the business, but underwriting is not profitable for 10 years. 1985, you can really see it starting to change, and that was Ajit Jain really transforming Berkshire's insurance business into what it is today.
What were your biggest takeaways from writing the book?
Biggest takeaways, I really came to understand how do I put this? How simple it is, but yet how hard it is. It's simple but not easy. I mean, that's really the story of Berkshire. This continual learning. They just continued to do the best that they could at every turn. They didn't have a strategic plan. They didn't have any kind, the shoe business that they entered in the early 1990s, that just happened. I really came to understand the value of float, insurance float, and how it can actually function very much like equity capital. That it just stays there, but the equity shareholder gets to essentially keep that money. And then another interesting one, I guess would fit here is, like I said, I didn't go into Buffett's personal life, but it was interesting to me to see this entrepreneurial spirit manifest itself in Berkshire Hathaway. So if you read The Snowball, or you read an account of Buffett's early life, he delivers newspapers. He, has his buddy die for golf balls and they resell them. He has a pinball business. He, famously buys a 6-pack of Cokes at his grandfather's grocery store for 25 cents and resells them for a nickel. The entrepreneurial spirit that is Buffett manifests itself in Berkshire Hathaway in the form of starting these home state insurance businesses over time. You hear him talk about stepping on the gas and pushing Geico forward to invest in new customers, even though it makes the financials look worse. Trying a credit card at Geico. So here's an interesting story. Buffett goes to Geico's management and says, you know what? I think that Geico policyholders, who on average are good drivers, are going to be good credit risks. We should offer them a credit card. Geico's management says, no, we think you're wrong, Mr. Buffett. he's, and I'm just paraphrasing or making this up, but he pushes them forward and says, no, we're going to do it. That credit card program loses Berkshire Hathaway, loses Geico $50 million. It was a $50 million mistake. And to his credit, he comes out in the annual report and actually says, this was my idea. They told me not to do it. But he tries these things. He's constantly pushing Berkshire Hathaway forward to try these things and take these calculated risks. And it's sort of an interesting dynamic between, this sort of seemingly stodgy, boring value investor that just, likes conservatism, right? And then you have this other flip side of trying things and taking risks and all of that. It's just kind of an interesting paradigm.
It's just an add-on to this, but what do you think about his understanding of technology? Because that story, it reminds me a bit of, if you listen to the meetings from the 90s, when he's talking about like trying to predict the impact of the internet, he's very, very good in some cases. Like, you could see how it would impact the insurance business and how it would benefit Geico. And despite him having that reputation of not understanding technology, I think with the internet, I think he got it quite early on.
Yeah, he really cuts through, and that's what we love about Buffett. He just cuts through to the economic reality of things. And the example that he gives was grocery delivery. This was tried. We have Uber Eats or whatever it is. Today, all these iterations. There was a .com company that was going to deliver groceries in the early 2000s. Buffett says, geez, I grew up in my father's grocery store, and we used to deliver groceries to customers. So all the internet's going to do is lower the cost maybe of ordering, but you're still going to have this physical component of delivering the groceries, and that's the expensive part. So he could discriminate, and he could see where the technology would help and where it would hurt. And even the economics question, and he puts it this way, of asking, and then what? Because if you take an industry and you apply technology to it, and all of a sudden it's 5 percentage points more profitable because you've reduced your expenses, well, where is that going to, is it going to then be reflected in competition and lower prices, because everybody in that industry are going to compete for the customers, and it's just going to lower revenues, and essentially that the benefit of the technology is passed on to the customer. And so that's I think how he looks at the technology, just in a very broad way, is it needs to stick to the ribs of owners, as Munger has said, and competitive forces are always going to be there, regardless of what the technology ultimately does to the cost structure of the business. And I think he's recognized that. But he's also recognized companies like Apple, right? And the benefit of a company like Apple, where you have such an extreme exponential curve, you can still be late to the party. You can be late and still do well, right? Because that exponential curve is so steep. And you saw Ajit Jain this past annual meeting talk about Geico going into telematics, which Progressive adopted earlier. Geico did not have to jump at that. They could let Progressive try it out and just buy the technology and just do it. It's a short tail business. You're going to have lots of feedback. And so I think he recognizes when technology can help, when it can hurt. He'd be the first to admit that he doesn't fully understand technology, that others can do it better. And of course, we just saw within the last couple of days here, Berkshire invested in a Brazilian startup fintech company, which was probably Todd Combs. But they continue to learn, and that's another big lesson that you can take from Berkshire.
I was going to say it a bit early on, but have you read the article "Why the Web Won't Be Nirvana"?
I'm sorry, what was the?
It's to do with it's a really, really interesting article. It's written in about 1995. It's called "Why the Web Won't Be Nirvana." It's just someone basically going through all the things people are talking about the internet doing and why none of it's going to work. Obviously, reading it now with the benefit of hindsight, it's a really interesting read, because almost everything in this article turns out to be wrong, but it is quite like a well-structured argument, and it's quite entertaining. But yeah, it just made me think of that.
Yeah, you'll have to send that to me. That'd be interesting to read.
Is there any takeaways that you had from writing the book that you probably wouldn't have expected at the start?
Well, like I said, I'll just kind of put a finer point on this. People have talked about the concentration in Berkshire's investment portfolio. So over the decades, the largest single or the largest 4 or 5 investments in the portfolio have been, the largest might have been 20%, 25%, and then the top 4, they go from 50 to 70 to even 80% in some cases. This concentration. But what I did, I paused in 2014, which was of course the 50th anniversary of Buffett taking control. And I look back over the decades and I said, what is the largest acquisition of each decade? And so it was interesting to see this progression. But in each decade, each of these 5 decades through 2014, in no case was it less than 15% of Berkshire's equity capital. So you have the Buffalo News, you have Scott Fetzer, you have General Re, you have BNSF. But what you see is this continual concentration, but it really leads you to the question mark of today, which is, okay, what is that next acquisition going to be? Because if Berkshire is, it's got a little bit less than this, but call it 500 billion of equity capital, to make an acquisition at 15% of equity capital, that's a $75 billion acquisition. That universe of businesses at the $75 billion mark are pretty few. And so it just shows you how hard it is for Berkshire today. Some other interesting things, I mentioned the float, I mentioned the entrepreneurial spirit. One other kind of really cool thing I found was Berkshire often borrowed in advance of needing any money. So we don't think of Berkshire as a big debtor, but it borrowed money for acquisitions, and it actually borrowed money in advance of making acquisitions. There were a couple times in the 1980s and 1990s, and Buffett even calculated. He said, "Geez, net, we're losing $150,000 a week on this borrowed money, but if we can find something intelligent to do with it, it will make sense to do this." And so the rationale behind this, which it just struck me, was the best time to buy a business and the best time to find financing don't often coincide, right? So why not manage the liability side of the balance sheet, borrow when it makes sense to borrow money, and buy good businesses or buy stocks when it makes sense to buy those? It just struck me as such a rational, logical thing to do. But how often do you see businesses borrowing money in a pretty big way outside of any major acquisition? That was kind of interesting. I'll just mention one more thing with the insurance businesses. They formed a bunch of these home state companies, like I said, but not all of them actually made it. It's another sort of entrepreneurial thing that Berkshire did. They bought this home and auto business in Chicago. It did really well. This guy, Victor Raab, founded the business, ran it. It ran really well. They said, let's try to replicate this business in Miami. Complete failure. They ended up closing the thing down. And so we think about the successes of Berkshire. We think about where it is today. And maybe we have sort of an inkling of where they came from, but you sort of forget about the struggles and the challenges of those early years, which is really, really fascinating to see.
Can you talk us through a few of the interactions, I guess, that Berkshire's had with the UK in terms of some of the acquisitions and deals it's been involved with along the years, just to bring it home for some of our listeners?
Sure. Yeah, Berkshire has a number of ties to the UK. In 1991, they purchased a pretty good stake in Guinness. I think it was about $105 million. They added to that a little bit the next couple of years, but then it kind of fell off the list of securities in 94. MyTech, which is a business that originally made truss connectors and things for building companies. It's in the construction industry. That was owned by Rexam, but the headquarters was in Missouri in the United States, so not really a UK company, but it had a UK tie. Berkshire has owned stock in Tesco, the supermarket. GlaxoSmithKline owns some of those shares as part of sort of a portfolio approach to buying some of these pharma companies. 2008, sort of the mid 2000s there. But I guess the big two I'll mention two. One is Berkshire Hathaway Energy, Northern Power Grid is this distribution business in northeastern Britain. So
I'm in the northeast, actually.
okay, I have to remember my shires here. Yorkshire and Lincolnshire come to mind as two of the maybe counties in that area. Today, that business serves, I think, about almost 4 million customers. So that business, Northern Power Grid, that was actually purchased by Berkshire Hathaway Energy today used to be called Mid-American Energy. Mid-American, its predecessor was this company called Cal Energy. Cal Energy bought Northern Power Grid in 1996 for around $1.3 billion. So that was sort of the genesis of Berkshire Hathaway Energy today. They still own it, and I think they're one of, if not the largest electrical distributor in northeastern Britain.
Okay.
And then just insurance is such a big part of Berkshire Hathaway. Lloyd's of London is a marketplace for insurance, and Berkshire has been a very big participant in Lloyd's of London. We mentioned Ajit Jain, and just a story if you haven't heard it. Ajit Jain, so he loves insurance so much. In the United States, we have Thanksgiving, usually the end of November. There's no counterpart to that holiday in the UK. Well, Ajit Jain apparently has flown over to the UK on Thanksgiving so he can continue to work on that Thursday. Just to show you his dedication to Berkshire and the insurance business.
I wonder where he goes at Christmas. That'd be a little tougher.
Yeah, I don't know.
Could you talk about your own investment appraisal process and how you'd go about looking at a new stock or potential investment, or a company that is either on your watch list or you're thinking of adding to the watch list?
Yeah, I think I'm closing in here on 20 years of actually being sort of involved in the market and looking for good companies to buy and so forth. And it's changed over time. And I found that the more I learn, the more selective I am on the companies that I will buy. So I'm always looking, and I look everywhere. I mean, I have friends in the business, or you read about a company in the paper. I'm really just trying the scatter approach to find any business that I can understand and looking at them. So it's a constant process of looking for new businesses, looking at the filings of other managers, trying to learn from what Berkshire's doing, what Buffett's doing, and other investors. But I mentioned, growing up as a business, around business and owning businesses myself. Stocks are businesses. That's how I look at it. And so first I have to understand the business. Then I look to really try to understand the economics of it and the competitive dynamics in which the business operates. And I spent a decade in banking. And so I have this risk first mentality of trying to essentially kill the business. What are the competitors doing? What could really hurt it? How could technology impact this business? And really just putting it through the ringer, trying to understand it. And I'm very much attracted to that watch list approach of investing, which is get to know the business beforehand. And then if something happens in the market that presents an opportunity, you'll be in a better position to understand the ramifications of what's happening and compare it to the price. So that's kind of how I approach new investments.
What are the best books that you've read on investing, and how much do you read generally?
Well, I have too many books. Shane Parrish calls it the anti-library, which I've come to embrace because it allows me to buy all kinds of books that I haven't got to. But I read as much as I can, and I very much I'm sort of the Charlie Munger mindset. So I'm not just business. I mean, I'm trying to read everything. I'm just interested in so many different things, but specifically with investing, I mean, I'm looking over here to the book I'm currently working through, Bruce Greenwald's Value Investing from Graham to Buffett and Beyond. They just released a second edition. Bruce Greenwald is one of my easily top 5 favorite investors, and he really cuts to the chase. It's almost as if Buffett was sort of giving you the formula to how to invest quantitatively, because Greenwald just talks about, it's such a logical way of approaching the investment process. And his other book is called Competition Demystified. Highly recommend that one. That book really helps you understand the true and few competitive advantages that exist in the marketplace. If you read the annual reports of almost every business, you talk to almost any manager in any business, they're going to tell you they have a competitive advantage. 99% of the ones that you talk to don't really have a competitive advantage. They just think they do. Greenwald sort of helps you see through the mist. Really, really good book. I can keep going.
I mean, any book you say that I've not read, I'm going to add some other reading list. So I'm happy for you to go on.
Yeah, I have, and actually, I'll pull up. So I have a book recommendation list on the Oracle's Classroom. So if you go to the website, I'm going to pull that up while we're talking now. We can. I'm sure there's a couple that I'm going to forget here. Snowball is very good, of course. Security analysis, all the ones that Buffett recommends. So here's just sort of a little, I don't know, tip, or just the one of the first books I ever read, which I've probably read or listened to now a dozen times, is Robert Hagstrom's book, The Warren Buffett Way. And in that book, Hagstrom talks about the influences on Buffett. So he mentions Graham, he mentions Charlie Munger. So, read Security Analysis, read The Intelligent Investor, read Poor Charlie's Almanac. Phil Fisher, so his probably most famous book is Common Stocks and Uncommon Profits. And then the one that people kind of forget, it's kind of dense, there's lots of formulas, but the basic message, it's called The Theory of Investment Value by John Burr Williams. I just went out and bought it, and just said, well, if it influenced Buffett, I want to read it. And it was interesting just to kind of go through and see the impact that those people had on Buffett. The Outsiders, Peter Bevelin's book, Seeking Wisdom, as well as a few lessons, all very good. So a lot of great books out there on investing and on Berkshire.
What do you read then? You say you read about a lot of subjects. What subjects? Are there any subjects you read a lot of that aren't investing?
I'm reading this book right now, The Story of Evolution and 25 Discoveries. That's a book about, it's interesting to think about biology and ecology in relation to markets, right? And you think of economics and ecology, they share the same root word. You talk about niches in ecological systems as well as in the investing world. I'm reading this other book. It's called Order Without Design: How Markets Shape Cities. Again, it's a book about urban planning, but it has touches of how cities develop and the economics behind it, and ecology. Again, you just find these things kind of prop up. There's this other book I just read. If you're into Charlie Munger, I think you'd really enjoy it, but it's called The Intellectual Life by this guy, A.G. Serdelange from France. I think it was written in the late 1940s, but it's interesting because he talks about, being distracted by, newspapers and things like that, just all the sort of same problems that we have today. Were the same problems of yesterday, but that's a book that very much, it talks about creating this environment for study and learning and just all of these things. Again, if you're into Munger at all, I think you'd really enjoy it. But I'm so fascinated in everything from science to history. Peter Kaufman, who edited Poor Charlie's, is a guy who I've come to admire, and read anything you can on him. But really, just there's so much wisdom everywhere in the world, and I'm interested in so much of it. But it does help broaden your thinking, and again, you find these insights into investing that you might not otherwise. You're just sort of strictly sticking to reading financial statements in the Wall Street Journal and what have you. I subscribe to Discover magazine, which is a science magazine. So I'm all over the place.
I'd say science is actually probably where I'm lightest in my own reading. I've been reading a lot of history recently. With science, I think I've probably only touched on it. I've read some Dawkins, the Selfish Gene.
Mm-hmm.
And then I've read a few of his other books as well. But yeah, science is where I'm probably weakest. And there are there's a few investors where they read a lot of sort of biology. So there must be something to it. With Munger obviously being the most famous example. So I'll have a look at a couple of those. I've actually got a couple on my list because when I went through the Berkshire meetings in the 90s, Charlie used to get the same question every year of what you've been reading. And there were a few biology books on there, so they are on my reading list.
Yeah, again, there's so many parallels between the economy and the competitive environment in which companies operate. You talk about evolution and change and finding, compete. I mean, those are the same things that's happening, outside your window and in your, in the forest or something. Species competition and change and adaptation and all of that. There's so much that you can learn. Really, so much of life is just figuring out all those interconnected ways in which the world is related.
How long do you think it takes you to read a book? So how many books do you reckon you get through in a year?
How many books do I read a year?
Yeah.
I used to, I haven't updated in a while. I include audiobooks in that too. A few dozen, but I've really come to slow down my reading, I guess, and not Shane Parrish from Farnham Street. I don't know if you have followed Shane or Farnham Street just in general. I'd recommend, using a book. I generally don't get books from the library because I want to actually make them my own and write in the margins, and you're having a conversation with the author, and sometimes it's okay. It's okay not to finish a book or read a little bit of one or pair it with another one. I've really come not to focus on the quantity, but really the quality. And I've tried. I mean, I buy new books, and as a guy who just wrote a new book, I probably shouldn't be saying this, but I generally filter what I will read based on how long it has been in print. So, Security Analysis was written in the 1930s. That stood the test of time. Some of the newer books are really just kind of flavor of the month, or just, they're more entertainment than proven value. I mean, you can pick up a book by Plato or Aristotle or Cicero. Those have been studied, debated, gone through the test of time, and the wisdom is going to be timeless. So I'm really looking for those timeless lessons wherever I can find them.
Well, for someone who's newer to investing, could you explain why you think Buffett and Munger's teachings are still relevant compared to, say, whoever the hot name is on Twitter at the moment?
They really are. It really is timeless. The things that we're so lucky to have them as teachers. They basically commented on what they were doing over the last 50 years. They've kind of given you the secrets, really, as to how they do it. And most of the lessons are timeless, and you can really take a lot away from just the rational thought process and the mistakes that they made, maybe, or all of that. Security Analysis, for example, written by Ben Graham. The examples in that book are, the older railroads or coal companies, or, some of these sort of older, boring businesses. But the lessons and the thought process associated with that are timeless, and that's why Security Analysis is so relevant still today. So Buffett and Munger, I mean, they have proven success, and you do really well to start with them and then expand from there, and challenge them, and don't look at what they say as the final word. You have to really, if you can understand why they did something and where they went wrong, that's a great way to approach it, because you really need to understand the why, not just the what.
What are the best resources that you use for investing? And they can be free or paid resources.
Yeah, so I'm a bottoms up guy. I do all of my own research. I just I pay for Morningstar, which I find to be a really good service. They give a nice history of the financials and the ratios. Even some of their analysis is helpful to get to know a company at the very beginning. But I generally go right to the primary sources. So whether it's the SEC website or the company investor relations website, I just have to read the 10Ks and any reports myself. There's this service. It's a paid service, but there's a free part of it called I think it's BAM SEC, which is sort of a summary financial statement, financial filings aggregator. So you can go on there and you can see the latest 13F from some investors or the companies themselves, and 10Ks, 10Qs. Twitter has actually become, I've just gotten on Twitter the last year and just seeing sort of the universe of, what people have talked about. That's pretty much it. I mean, other than, again, reading the Wall Street Journal, reading Fortune magazine, those kind of things.
Which Twitter accounts would you recommend following the most then?
Oh, geez.
You can plug yourself as well as part of this if you want.
Yeah, my handle is BRK_student. I didn't plan it, but upon reflection, I said, geez, _student, the underscore. People look at me as an expert on Berkshire, but I'm still very much a student of Berkshire and investing. So to underscore that, Chris Bloomstrand is really great. His logic and thinking. I don't want to exclude anybody that I should be talking here, but like John Mickelvick from Manual of Ideas, or Guy Spear. I think Monish Pabrai is on there. There's a lot of good ones, and really just I'm still kind of learning how to use Twitter and getting into these chats and threads, and it's kind of interesting how dynamic it can be. I'm just going to pull up my list here just so I can see maybe some of the bigger ones. Ian Castle, I follow Tobias Carlisle and Bill Brewster, Jake Taylor. Those guys do the Value After Hours podcast. They're pretty good. The Rational Walk, just kind of, I mean, certainly if anybody's interested, you can see who I'm following, and just kind of look through that list. But I try, you hear Charlie Munger talk about getting into these sort of self-selected groups where you're sort of just in an echo chamber, right? I try very much to, both on Twitter and then I'm on Facebook a little bit and LinkedIn, try to follow people that have contrary opinions. So I've tried, for example, to understand Bitcoin. And so I'll follow some people that love Bitcoin. It's you want to unfollow them. You want to sort of just get into that like bubble where it feels good and people are talking about value investing all the time. But I find that if you can challenge your own thinking, and a great way to do that is to subscribe or follow to people that you disagree with, and it's gonna pop it up in your feed, and it's sort of this automatic reminder like, oh, there's different opinions and I could be wrong. So I hope that helps.
What are your thoughts on Bitcoin then?
I don't understand it. I think there's some interesting, from what I know, which is very little, the blockchain technology could have some interesting things, but I just don't know enough about it. What I have seen, just this speculative fever, and it just doesn't resonate with me as an individual or as an investor. I'm not very excited about it, and I've largely stayed away from it.
Have you come across Preston Pish, sorry.
Yeah, those guys, Preston Pish, and you're talking about the investor.
Stig's the other one, yeah.
And Stig, yeah, I'm going to be going on his show later this month.
Wow.
I've listened, yeah.
Preston's a big Bitcoiner, and his approach is, I think you'd like, it's very, very like quantitative and math based. I mean, he's got his own Bitcoin show on Wednesdays, but I'm sure there must be. Preston Pish is definitely worth following, and his Bitcoin arguments, it's definitely not speculative reasons that he's got it, and it's very, very quantitative. There's another guy called 100 trillion USD on Twitter, and what he's done with it is he's taken an approach for valuing precious metals where you look at the the supply already in circulation, and you compare that to the new supply that's created each year, and look at how that's impacted precious metals over the years. And obviously with Bitcoin, because the supply is known and the new creation's known, because it's all on an algorithm, he's mapped out what he thinks the price is going to do based on that. So those are a couple of guys that are quite interesting if you are looking for a bit more.
Thank you. Berkshire bought, what was it, like 100 million ounces of silver, maybe in the late 90s.
I used to get the questions on it every year after he bought it.
Yeah, and that was an example of Buffett looking at the supply demand dynamics and just finding an obvious mislocation of value. That may hold true. So here's, and again, I'm still thinking about it, actively. I don't have really an opinion, but when I think about, okay, yes, the supply of Bitcoin is fixed, but you have all these other copycats, right? So is the supply of, what's the generic term, cryptocurrency, is it really fixed? No, and I guess it would ultimately require everyone adopt the same coin, correct?
I don't agree with that. I think that's what you're discounting there is the network effect, and that's like me saying, well, I can take Facebook's code and I can copy that and I can just create Sambook, but if no one's going to use it, and that's where the network, it doesn't matter if I create a website that's 10 times better than Facebook. If everyone's still using Facebook, it doesn't make any difference. And I think that's what's missed. You can fork the code and create your own version, but that the value is not going to go with it. And I think people realize that in the Bitcoin community. And I think if a good example is that if you do start digging into Bitcoin more, in about 2018, there was a fork it was some of the key developers, actually. It was one of the big arguments in Bitcoin is, do you increase the block size? And basically what the block size is, the block size allows you to do more transactions in a block. So it means you could speed up the number of transactions. And there was a group that wanted to go to bigger blocks. And the issue with bigger blocks was that it meant that it was much harder for someone else to run a node. And there was this group that basically said, well, we're going to go off and we're going to change the code so we've got bigger blocks. And they tried to get everyone to follow them. And there was a literal price war in 2018. And this spun out, and it was called Bitcoin Cash. And at the time, it was not clear whether the original protocol was going to win or whether everyone would flock to Bitcoin Cash. And if you look at the price of Bitcoin Cash now and compare it to Bitcoin, it's very, very obvious which one has won. And there have been numerous other ones which have spun off since then. There's been Bitcoin Diamond, there's been loads of them. And they just don't compare because they don't have that network effect. And also with the network effect, it's backed up by what the miners, I don't know if you're aware, but the miners basically add security to the network with their processing power. If the miners don't follow that Bitcoin Cash network, if you wanted to do a 51% attack, so if you wanted to try and take control of the blockchain, all you need is enough computing power. With Bitcoin, it's just not feasible to do it because of the cost. I mean, when you see the electricity, where it's using as much electricity as some countries, that is the cost it would be for you to take over the network effectively, because you need 51% of that electricity to have any chance of overpowering it. So I don't think that the other coins are really comparable. I view it the same way as copying and pasting some code on a website and then not having the users with it.
So how do you explain, and again, I claim no expertise here, but just from what I know, the Dogecoin, or what's the other big one, Ethereum, why? I mean, those have huge market caps, right? Why?
But that's like, to me, that's like, the way I see it is I think there's Bitcoin and then there's everything else. And Ethereum is very interesting. And if it does what it says it's going to do, then maybe that will be a fantastic investment. But when I first started getting interested in Bitcoin in 2017, Ethereum was making the same promises and it's not really delivered and it's not got the usage. Whereas Bitcoin is delivering. And with Dogecoin, I mean, that's to me like saying, well, how can you invest in the stock market? Look at GameStop. Like, how can the stock market be a legitimate way of investing your money when GameStop has no link to reality with its valuation? And I think that's that's one example, and that doesn't. They're not all grouped together in that way. I think Dogecoin is Dogecoin, and it does help if you want to run up the market cap or something to have the world's richest man with no filter on Twitter, just talking about it all the time. It is going to impact the price.
I probably demonstrated that I don't fully understand it, but I guess ultimately the proponents of it today are banking on the adoption of it, but ultimately what they're saying is Bitcoin will become adopted as a currency that can be used to transact business, correct? Like it'll be a currency substitute, right? I mean, is that sort of the basic?
That is what I view it as more of a. I mean, there's the means of exchange, but I view it more as a store of value. I don't really see a scenario where you're going into Starbucks and you're paying for your coffee with Bitcoin, even if it can be done very, very cheaply. I do view it as more of like it. I view it as akin to a digital gold. You're not going to go into Starbucks and hand over a lump of gold. It doesn't. Even if they start accepting it, you're not going to do that instead of a coin. But I think it does give you a way of opting out of maybe the current system if you did want to store your wealth in another way. It's more of that store of value. I do, for me, it's the digital gold argument that makes the most sense. If you're an investor where you think, well, I'd never invest in precious metals, I'd never invest in gold anyway because they don't produce anything, I'd expect you're going to come to the same conclusion with Bitcoin.
Yeah, that's how I view it. I mean, ultimately, whether it's the means of exchange or a store of value, I guess ultimately what it comes down to is having that claim check on future output, right? So if you're gonna essentially store your time in Bitcoin and you're gonna take it back and buy something with it in the future, it's stored time, right? It still leads me to the same conclusion that, geez, I would rather own a business. I'd rather own a stock, regardless of how the currency is denominated. Because if I own Coca-Cola, that business is going to be producing something for society that's going to have a claim on the future output of society. And whether I'm paid in dollars or seashells or Bitcoin, it's the system which is a business, is going to produce that. So that's kind of where my current thinking is, because I view it at best as a currency or maybe a gold equivalent. And in either case, I'm not interested in it.
Yes, I think that's fine. But that's more of like, I guess that's more of like it's more of an informed decision, because it doesn't produce anything. It's never going to. Whereas I guess when you're saying, well, what are the other coins? Why I don't think that's the case. But it definitely doesn't produce anything. You're not going to get any dividends from it. And if it's just one of the things where it just goes in the too hard pile, then I think that's.
Yeah, that's kind of where I am, and I think your logic sounds reasonable to me, and the fact if it ultimately sort of we're in this sort of whatever they call the the universe at its earliest state was in this sort of like plasma, sort of messed up state. We're in this messy period, and eventually 20 years from now, maybe Bitcoin shakes out as sort of the one. It has the network effects. It wins. It's stable enough that it could be used as a means of exchange or a store of value. If that's ultimately the case, I'm still not interested. Maybe people will see it early and benefit from it, but I'd rather focus on what I do know and I'm more certain about, which is certain businesses.
Yeah, I mean,
I appreciate your thoughts.
Yeah, for the record, I don't see a scenario where I'm getting paid in Bitcoin and everyone's doing. I view it as just something that's going to sit alongside the current system, really, rather than replace it in a similar way to how gold functions. I think if you're an institutional investor, I do see a scenario where people are they're putting a couple of percent of the portfolio in gold, and I think we are starting to in Bitcoin. And I think we are starting to see that a little bit. And I'd view it almost as a commodity. I think it would sit in that part of portfolios. But if you don't invest in commodities, then
I don't. Yeah.
So who do you look up to as an investor then that you've not already mentioned?
Yeah, Buffett, Munger. Again, as I've kind of expanded my my investment horizon. Howard Marks, I've really come to admire. Bruce Greenwald, I mentioned. Pat Dorsey is another one. Guys like Mario Gabelli or Tom Russo or Tom Gaynor. Those sort of value investors in the Buffett Munger sort of orbit. All of those guys. Yeah, I'd probably leave it at that.
What do you know now that you wish you'd known when you started out? And if you could speak to yourself when you were starting, what advice would you give?
Yeah, again, it's interesting. It's a great question because I see now, looking at like, for example, I'm in a value investing Facebook group. It's got like 100,000 members, and I can see some of the same sort of questions and the sort of same thought processes that I had, maybe 10, 15 years ago, which is really, I guess, the one piece of advice is, first, view stocks as businesses, but spend time to think about the economics. I see too many investors looking for the formula, or if they have a formula, or maybe it's a complicated one, or maybe it's a simple one. But I see investors saying, well, geez, here's the free cash flow, and I'm going to assume this growth rate and this discount rate, and there's the value, and oh my gosh, look at this margin of safety. Really take a look under the hood and really look at the economics of the business, and ask who are the competitors, and ask how are they producing this revenues. Just all of that wonderful sort of nuance that's behind the hood, not just what the free cash flows are, but how have they evolved over time. I've very, very much come to start. I like to view the history of a business, like at minimum 10 years. And I go through and I look at the capital allocation history. And I do this in my newsletter as well for most of the businesses that we look at, just to see, okay, what were these major capital allocation decisions over time? How was it generated, first of all? I mean, there's just very few ways. You can either raise capital by organic, earnings, or you can borrow the money, or you can have additional capital contributed by equity holders. Those are pretty much the three only things that you can raise capital from. And then using capital, you can pay dividends, you can buy back shares, you can reinvest in the business, you can pay down debt, those kind of things. There's few categories, but if you view that history over time and the major capital allocation decisions that were made and really understand the business, I think you'd be a better investor. I've become a better investor. I still have a long way to go, but stay away from that really mechanistic. If it can all be done on a spreadsheet, you're probably not quite there, because we know there's enough computing power out there today that if it can be done in a computer, it probably already is.
So have you evolved as an investor yourself then?
Yeah, again, I've kind of followed that path of, I actually keep a spreadsheet, a document I've called the Folly Gallery. So this is a spreadsheet, a place that I put down, and I rub my nose in my mistakes, to use a Munger term. I put all the dumb things that I've done over time, like 2007, 8, just again, sort of mechanistically, like, oh, geez, let me buy this stock because it has a 10% dividend yield. Yay me. Well, what did I buy? I bought a mortgage REIT in 08, 07, 08. Well, that tanked, and it tanked for a reason, and it had a high dividend yield because the dividend hadn't been cut. I've done some other dumb things like that. I've stopped using any margin or anything like that. No options, anything like that. But I've done these things in the past. And so if you're going to do it on a small scale, but eventually you'll come to the conclusion that it doesn't work very well. But that's how I've evolved as an investor. And everything has pushed me toward thinking and acting like a business owner and trying to remove all of the noise that's associated with everything else. And again, it's led me to a path where I'm very, very selective today, and skeptical of my own knowledge of a business. And I really need to know the business very, very, very well before I'll invest in it.
What do you think of current valuations generally in the US?
Not cheap. Yeah, things. And you hear Buffett say, "Geez, if earnings stay as high as they are, and if interest rates stay low, markets aren't overvalued. But I look around and I just see, there's certainly pockets of value, but you have to sort of just, Howard Marks, I mentioned him earlier as someone I follow. Marks has this sort of like litmus test on the market, this sort of like rough feel. And in his book, The Most Important Thing, he talks about it, where you can kind of just roughly take the market's temperature. How are interest rates generally? What is sort of the general attitude of investors in the market? Is credit easy or tight? Just these sort of things, and all of these indicators on, just point to things being overvalued. It's certainly been, it's been a long run, and I don't know what or when it will change, but I'm being very careful today.
Do you look at UK listed stocks at all?
Not, I don't exclude them. I'll say it that way. I don't just search in the United States. I mean, if I come, I've, talk about another mistake. I've bought a Chinese company, which turned out to be sort of a semi-fraud. I generally feel most comfortable in the United States. And then sort of right outside of that is, like, I own a company that's technically domiciled in Ireland now, but UK, sort of, Western Europe, I'm okay with that. I would have no reason to not buy a UK based business.
I think the valuations in the UK are very low. We've got in our index, we've got a lot of old economy stuff that's certainly not as high quality as the stuff you've got. Like we've got, if you look at the FTSE 100, which is the biggest 100 stocks in the UK, there's a lot of banks, there's a lot of pharma, there's mining. It's that kind of old economy stock. So that is part of the reason that the valuations are lower. But even still, some of the valuations in the UK, I think, are very, very reasonable. Certainly when compared to the US, because my own portfolio is split about 50-50 between UK and US. So how do you think about allocation and position sizing?
Allocation and position sizing. I don't set out to have any kind of like master design. I really take that approach in terms of finding the best businesses that I can. I mean, I'm conscious of the concentrations that might arise. So, if all of a sudden banks become cheap or insurers or something, like, I don't want to have the whole portfolio on that, right? Position sizing. I very much take the view of Charlie Munger and concentrating my bets and using the best one that I currently own as the threshold, as the opportunity cost. I'm gonna try out a new this analogy I've been thinking about. I'm gonna try this out on you. So you have a deck of cards, right? You have there's 4 aces in there, 4 kings. Go down the list. If your hand already has 3 aces in it and 3 kings, we'll say, right? You have 6 great cards. You've gotten to know those cards. I mean, you know clearly what they're worth. Whatever game you're playing, poker, we'll say, because they're valued. But if you have 3 aces and 3 kings, you've got 6 cards out of the deck of 52. So there's 46 cards left. What are the odds of another great company coming up on the next turn? It's going to be pretty low, right? So where I'm trying to go with this analogy is you've done the work, assuming you're at a point where you have a pretty good portfolio. It's going to really take a lot to add something to it, right? It's that whole, how is your, in this case, 7th best pick better than maybe that ace that you already have? Now, if an ace comes, right, you have a 1 in 46 chance of that next card being an ace. If an ace comes, maybe you discard a king, or maybe that other ace that you have is overvalued or fully valued and you want to exchange it. But the whole, I hope this is coming across, that the real great opportunities are few, and that leads to having a concentrated portfolio and leads to low turnover and low activity, and continued searching, looking for that sort of final ace in the deck, if you will. So that's kind of how I've come to think about it. I don't know. You can tell me if that analogy worked or not, or if you'd change it.
No, I like it. Yeah, I can't remember who the quote's from, but it's the best. It might be Peter Lynch, where he says the best business is probably one you already own. I think it's Peter Lynch. But no, I like that. I look forward to hearing it on the Investors Podcast in a few weeks' time when I listen to that.
Yeah, I should. You think I should try it out? Yeah, it comes back to owning businesses. I mean, I view myself as a business owner, and some of the businesses I've owned. I mean, I've talked to the management, and Berkshire. Won't surprise you that Berkshire Hathaway is one of the companies that I own. I mean, I go to the annual meeting, and I've shook Buffett's hand, and I've shook Munger's hand, and I've talked to the managers, and it's just why would I want to sell that? Like it's I wear Fruit of the Loom underwear. Like I view it as an ownership of a business, and if I don't make a trade in a year or two, I mean, that's fine with me.
So move on to the next part of the interview, and this is questions more about your actual portfolio rather than your philosophy, I guess. So you say on your website, Mead Capital Management manages private accounts through a careful selection of a small number of competitively advantaged companies purchased on the basis of sound principles and stewarded with an even temperament. Could you just expand a bit? And I think we've sort of covered it earlier on, but why these things are important to you?
Yeah. I tried to pack, that's sort of my elevator pitch, if you will. We talked about the small number of companies. They have to be competitively advantaged. And, I'm not averse to buying an average business at like a super, great price. We're 180 degrees probably from a scenario where I would find that. But I'm looking for good businesses with a moat, with some sort of competitive advantage, the ability to grow, all of that. That gets, then the principles part of it. Thinking like a business owner. I mean, it's as simple as that. Stocks as a business, looking at the economics of a business, understanding the accounting and the management and all of that. I won't mention the name of this business, but there's one that's sort of, I don't want to say popular, but well-known as sort of touching the value investing community, sort of a lookalike. He's kind of a sketchy manager. I don't want to become a partner with that person at any price. Just my quirk, kind of like buying a tobacco company or something, and then steward it with an even temperament. I mean, that's sort of the last. That's the keystone, I think. I've come to view what I think is an advantage that I have is having an even temperament, is being rational, being okay. I mean, I lived through 2008 and 2009 when the market was down big for a longer period of time than last March. I mean, I lived through last March too, with client accounts, and being rooted in thinking about businesses, thinking about stocks as businesses. And for whatever reason, my genetic makeup is such that I just don't panic. I don't. It does not bother me when stocks go down. It's a challenge having clients sometimes and trying to communicate that, hey, the businesses might be only slightly affected, or this is a great buying opportunity. But that temperament, I think, is a big piece of the equation, that you have to have that, or at least know yourself well enough that the textbook might say that you have to do this for your portfolio, or your investment advisor might be saying that, but you have to know yourself best. And I think I have the right temperament for this business, but time will tell.
It reminds me of the Buffett quote, when things are down. I always go back to that quote. I'm going to butcher the quote, so apologies for that. But I think it's something along the lines of celebrating when stocks go up is like celebrating when gasoline goes up, because you've got a full tank.
Yeah, he's used gasoline. You just fill up your car and then gas doubles or something. Like, would you rejoice? No. Or why would you be happy that the price of hamburgers or food or something has gone up in the grocery store? it's kind of a paradox, right? We recognize
Yeah.
value in every other walk of life, but it's I try to explain it to my brother and my sister who are not finance people. There's tendency to view your brokerage account as a savings account, and it's like, hey, someone just reached into my account and stole 10% of my portfolio, right? Well, that's not how it works. It's just a quoted value. But if that doesn't click for you, you got to take an approach that will both work in theory, but also work under the conditions that you've set in your own life. Because if you cut that short, and I've seen people do that where they sell at the low and buy at the high. It's destructive long term. It really is.
You're long only. Why did you decide to take that approach?
Yeah, I talked about some of the mistakes earlier. And it all comes back to viewing stocks as businesses. So, mirroring the private business world, and I've operated in the private business world as a commercial lender, and so I just if the stock market didn't exist, what would you think about? You'd think about the financials. You can't short a private business, right? Like if I want to go in town and say, geez, I want to short this McDonald's franchise or short this gas station or this apartment building. There's no mechanism to do that, right? It doesn't exist to my knowledge. If it's a REIT or McDonald's stock or whatever, you can short that. But shorting, just to go a little bit deeper, there's value in. I'm not knocking short sellers because they have a value in terms of keeping that rationality in the marketplace and uncovering fraud and all of these things. I've just come to the conclusion that I will do a better job as an investor, returns, minimize risk, maximize the returns that I can get for myself and my clients by eliminating all the noise of everything that is not directly consonant with a private business. And that's why I'm long only. All my clients are in cash accounts. We don't short. We don't borrow on margin. We don't use options. Basic, boring, buying businesses, but buying good businesses, and that's where the excitement is.
So that, I think, leads on quite nicely to the next question. So again, it's just a quote from your website that I'd like you to expand on. So it's stocks are businesses and should be purchased on the basis of sound business principles. We look for businesses we can understand, that have some sort of competitive advantage or moat protecting strong returns on capital, and that are operated by shareholder-friendly management teams. The business is only purchased if available at a rational price that we feel carries with it a margin of safety. We believe satisfactory long-term results can be achieved without the use of margin options or short selling. So yeah, could you just expand on that and why you do believe those things, particularly the moat and the competitive advantage part?
Yeah, like I said, that's sort of the those are the aces that I'm holding, right? Those are those great businesses that have good returns on capital, great management teams, they have reinvestment opportunities, all of that. But the kings are just as valuable in that deck, or the queens, and those might be businesses that are more like a good or average business, but where the price makes sense. And so it's always this dynamic, this trade-off between business quality, but if everybody knows it's a good business, they're going to value it at such. It's not obvious where the value is. So good businesses, it's sort of another risk. A way I control risk is if I'm wrong about a great business, as long as I don't wildly overpay for that business, I'm going to be protected from doing dumb things. So I'll just pick a company out of the hat. I've used Coca-Cola in the past. I don't own it directly, just through my investment in Berkshire Hathaway. If I overpay for a business like Coke, if I'm trying to, I don't even know what the market cap is today, but if I think a stock is worth $100 a share, and it turns out that it's only worth 90 or something, or 85, all that might happen probably is that my compounding rate of return is going to be a little bit lower than it probably could have. If I'm wrong on a business that goes bankrupt, I've got a zero, and that's a big hit. So it's another way of incorporating safety into my investment process. The good businesses, you can generally you on an absolute basis, a Coca-Cola is way better than a some newspaper business today. I mean, we can both agree on that. So I'm not trying to get into the fine points of a great business versus a slightly less business. But if generally speaking, if I'm invested in a good business, something good is probably going to happen. Again, all the other things we talked about, finding a shareholder-friendly management team. Generally, I like having companies that have good and big insider ownership with shares that they've acquired themselves. And then again, a rational price. I don't believe in, hey, geez, to use an example from Berkshire, the Union Pacific Railroad is valued at 25 times earnings. Therefore, the value of Berkshire's railroad should be 25 times earnings. I look at the cash. So this relative valuation approach does not excite me in the sense of, geez, this business is worth this because its competitors or the market's valuing it like that. If something's valued at 25 times earnings, that's a 4% earnings yield, and you got to consider the growth that's in that component. But I'm really just looking, again, private business, forget about the market. How much cash can this business give to me based on the purchase price that the market's implying today? So you look at the market price, you say, okay, what's the market cap, or what's the enterprise value? That's your data point. Then sort of forget it and just, okay, well, how much cash is this business generating and rational compared to that market price? That's what keeps me from paying, these 50, 30, 40, 50 or more times multiples. It keeps me away from all those tech companies. And I know I'm going to be wrong in some of them, but the chances of being right are in my opinion, vastly higher if I'm in something I can understand.
You say as well, when an opportunity does arise, we believe in conviction. Client portfolios are generally limited to 10 to 15 businesses, with the top 5 representing the majority of the portfolio. This approach is consistent with a business ownership mindset. And in addition to that, you've only got 6 stocks in your portfolio. So is that due to lack of opportunities and current valuations, or is that just because you believe so much in those businesses that you want to be that concentrated?
Yeah, both. And again, it won't surprise you that Berkshire is one of is the biggest. But I take that business owner approach and say, well, geez, if I look to Berkshire, right, I don't own one stock. I own all of the Burlington Northern Santa Fe Railroad, which was in the Fortune 500, was in the S&P. I own all of Berkshire Hathaway Energy. I own all of Geico. All of these businesses. Berkshire itself is this hugely diverse. I mean, Apple is what, 15% of Berkshire's market cap. So do I really own 6 stocks, or do I own, how many businesses do I own? And I look through the stock ticker symbol and try to determine what the businesses are that I own. So that's why I'm comfortable with that concentration. I probably wouldn't be as concentrated if that top stock wasn't Berkshire Hathaway, just because of the breadth that it affords. And I've purchased it at very good prices. And then it's the things that you said. So both the opportunity cost of, okay, can my 6th or 7th or 8th or 15th pick really be as good as the first 1, 2, or 3? Probably not. So that leads to the concentration. And yes, it is harder to find good value today. But I will hold on to a business. My threshold for buying, there has to be that clear margin of safety. But if a business runs up to 110 or 20% of what I think it's worth, I may not sell that. So that's what might lead that number 1 or 2 pick or largest business, it might not be that great of an opportunity to sell it. So I want to keep it in the portfolio. That's why I might add that number 7 or 8 or 9, but that's always the threshold. And so I hope that helps. I think if we have this watch list that I've created, and if we get the nice bear market and stocks broadly are down 50 or 60% or something, I'm going to go shopping. And so I would expect that number to rise over time a little bit, but anything over 10, I think you're really getting too diversified.
So yeah, unsurprisingly, Berkshire's in the portfolio. How do you feel about the current market cap, the valuation, and its potential for market beating returns going forward? Or do you take the view that it's such a good company, it's so safe, it doesn't need to beat the market as long as it does well?
Yeah, I think, and again, nothing here is investment advice. I do have to say that because I am registered as an investment advisor, and but I'll talk sort of generally about valuation. And Berkshire. I think it's really important to understand, just sort of adjust your expectations, if you will, with Berkshire. I mean, it is this behemoth with almost 500 billion of equity capital, a market cap of 650 or 660 billion. It just simply cannot grow like it did in the past. I mean, that will not happen. But Berkshire is the Rock of Gibraltar in terms of, I mean, it's got all this cash. It's structured in such a way that it's resilient. It can actually take advantage of market stress. It's not going to be reliant on anybody else for outside capital in any kind of stress or situation. And it's pretty fairly valued. I mean, it's a compared to everything else, it's a decent value out there today. And look no further than Mr. Buffett purchasing his own shares, which would tell you something about the attractiveness of Berkshire, keeping in mind the lack of opportunity out there generally in terms of interest rates and the stock market as a whole.
So one of your other holdings is HIFS, which is a small bank in Boston. What attracted you to this company?
I'm a little reluctant to talk too much about it because it is such a small. I think it's probably a 600 million market cap, but the price has run up quite a bit lately. So I'll dive in a little bit here. So Hingham Institute for Savings is this bank just south of Boston. Is this town called Hingham. It is probably the best run bank I've ever seen. They know exactly who they are. If you look at their investor presentation from their annual meeting, they have an entire slide, Sam, on what they don't do. They understand that they're in a commodity industry. They have an extremely efficient cost structure. They have an efficiency ratio in the 20s, and for non-bank investors, an efficiency ratio is basically an overhead ratio. So their overhead is very, very low. They only invest, they make loans, but they have a strategy of focusing on multifamily and commercial real estate. So they know their asset class very well. They've had basically no losses over the past, 25 years. And the management team just really gets it. They own a big chunk of the bank. And again, they understand they're just relentless about taking out cost. They're constantly thinking about risk and growth coming second, really. I mean, this bank has grown at a very good clip over the years, but safety is first. From my own personal experience, I used to work at a bank. The general structure is that you have, starting from the loan officer up to the board, varying levels of approval in terms of loan authority. So if you come to me, Sam, needing, $100,000 for your business, I might be able to do that on my signature. If it's $1 million, I might need my boss. If it's $5 million, I might need the loan committee. And if it's, $10 million, I might need the whole board approval. Hingham has no loan authority. Every single loan is reviewed at the board level. Board members view the properties. They own 1/3 of the bank. So they're the ones approving these loans. So by extension, they're going to only invest in projects that they deem safe, and the track record really speaks for itself. So it's a very, very good bank.
For me, banks go in the too hard pile, so I don't have much
Okay.
experience to draw on. I had a very quick look at it, and it's at a PE ratio of 10. Is that a good metric to use for the bank, or should it be something else like the book value? And what do you do when looking at a bank that differs when you're looking at another type of company?
Yeah, banks are definitely a special animal, and you can get in a lot of trouble because there's so much that can happen internally that, you know, you have this, you can have a cancer growing below the surface, and all of a sudden one day it erupts. You've seen that in the 2008 banking crisis. You've seen that with Credit Suisse, with Archegos, or, you know, the hedge fund that blew up there. You have these risks that can be behind the surface that just blow up, and there's really no way as an investor to understand what those risks are. You really have to rely on the track record of management, and having a management team that's not only incentivized, so you have the track record, but incentivized with their own capital to make good decisions, and take good risks. So you got to be careful with a bank. I mean, they are leveraged by definition, generally speaking, at 10 times equity capital. So that creates these sort of distortions where I have an intern working with me right now, for example. I said, geez, look at this bank. It's got, you know, more cash on its book than the market cap. But that's pretty much the case with almost every bank. I mean, Bank of America, it has that situation too. So you got to kind of be careful and remember that a bank is leveraged. It has equity capital. It might have a little bit of debt, but it's going to have deposits as well. And backing those deposits is going to be a lot of cash. The other thing you got to be careful of is the accounting. So at least in the United States, security gains and losses get passed through the income statement. So that I can't tell you. I trust that PE of 10 is you know, a current number and probably reflective of the actual GAAP earnings. But I don't know. You know, Hingham has securities gains in there, and you really have to look at not only the current earnings and the adjustments, so just operating earnings, so exclude any of these sort of one-time capital gains and losses, but also where we are in the cycle. Almost every single bank over the last couple of years, with maybe the exception of some of the pandemic-related losses or charges, and I always tend to look at actual charge-offs, not just the reserves, because those are the cookie jar. The losses are actually, you know, gone. That can play into it as well. So we're at a point in the credit cycle where banks are doing pretty well. They haven't really had many losses. Looking at a bank through the full cycle is really how you want to look at it, because it's very a saying in banking is that anybody can lend out money. The key is to get it back. So when we go through the next cycle, you know, you'll find out, to use Buffett's quote, who was swimming naked. And you know, with Hingham, they have a track record that dates back to the mid 1990s, and you know, that speaks for itself. So that PE of 10 is probably closer to maybe 15 if you look at it from a sort of core earnings. And again, understanding that they've been operating with a tailwind, and management even tells you that they've been operating with a tailwind, which is another indicator in itself.
Okay, so that's the end of our questions. Is there anything else that you'd like to discuss that's not being mentioned? Or
no, I think this has been great, Sam. It's really great to have the long form, have all this time. I hope everybody has made it all the way this far. Hopefully I wasn't too boring and too long-winded here, but it's great to really dig into the nuances of Berkshire and all these things and expand. So this is a lot of fun.
Yeah, it was. I'm looking forward to editing it. But yeah, so I think people will have made it to the end. If I'm looking forward to listening to it all again, hopefully that's a good indicator.
Yeah, and please, like I said before, I really view myself as a student still. I've benefited enormously from others being very generous with their time and their insights. And you know, reach out. If you read the book, let me know how you like it. Let me know if I missed anything. I just found a couple of mistakes in the book. You know, I love the conversations. I love all of it. So please reach out. Please continue the discussion. And yeah, looking forward to this coming out, interacting with folks, and all your other guests as well. I learn a lot from you guys. I mean, it's great to have you podcasters uncovering some great value and really adding a lot to the conversation.
So where can people go if they have made it to the end and do want to learn a bit more about you?
Yeah. So again, my Twitter handle @BRK_student. You can go to the Oracle's Classroom or brkbook.com or watchlistinvesting.com. And either one of those, you'll find out more about me. You'll find a way to reach out to me. So look forward to hearing from everybody.
Okay, I think that's everything then.
Awesome. Thanks, Sam.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter @TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.